the impact of big order. We have this order from Frank, which caused this gap in between the bid and ask, and the impact of big orders is of interest for us because liquidity is never is not always the same in the market. Liquidity is something like volume that is fluctuating. There are moments of high liquidity, moments of low liquidity, and the impact of orders, especially big orders, is something that we constantly see in our price chart, right? In our previous session, where we talked about this structural aspect of the OTC FX market, we also discovered that the liquidity numbers, which are usually mentioned when speaking about the size of the FX market, how tricky it is to use those numbers, because I will summarize here very simple what we said in that session, which is if you take that apparently huge liquidity and you really start dissecting all the types of orders that give way to that accounting of I don't know, it's like right now from the last Bank of International Settlements, I think we are 5 trillion average per day in transaction volume. But if we go ahead and see really the part of that liquidity which is capable of moving prices, we probably land with 1/3 of that liquidity, and then still this is an average price for the entire FX market. So we would have to dissect not only in different currencies, but also think that those numbers are based on a 24-hour average. So, but on our intraday movements, which we see on our chart, this daily average is has to be brought down to a smaller number. So we would have to divide this number through 24 hours, and then this 24 hours through 60 minutes, and still you are having an average per minute, or in a minute, a lot of orders can be executed. So if you divide this volume number, this turnover through 60 seconds, and then you divide by all pairs in the correspondence amount, and then you divide by sellers and buyers, you realize that you really don't need that much liquidity to move this market, right? That is the conclusion that we derive from those average numbers. Okay? So when we talk about the impact of big orders, we don't have to think about extraordinary orders, but orders of that which are simply happening all day long. Okay, fine. So let me see if there are any questions. Can you share it? I think it's a bit of humor being shared here, which is also fine. Yeah, liquidity has to be related to the fee. So it was not done on purpose, but I guess can be seen in such a way as well. So what we have here is a logical dispersion of the different types of buying and selling interest. We stay with the same price scale and the same current price, which was between 64 and 65. And here we have all the pending orders, means all the limit orders to sell above current price and to buy below current price. Those pending orders, we think back in the fish market example, where simply the people there shouting their prices, say I sell for this price, or I would buy that price. This is my limit. All these are the limit orders which we constantly insert on our trading platforms. So here we see what we explained in the last session, that these limit orders offer liquidity to the market. Okay, and this is an important point. Limit orders are offering liquidity. Then we have the latent interest, which are those orders which are not yet placed in the market because price is far from those levels. Latent interest will change into pending order as the price approaches that level. Traders will start to program their orders onto their platforms. If there is enough time, they may use pending orders. If the market moves very fast, they may choose a market order for immediacy. Okay? And immediacy was in our example what Frank, our trader, did. He wanted to trade now, so he wanted immediacy, and he was placing a buy market order, right? And Joanna and Ingrid, they were willing to transact at different prices using pending order, and that is how the liquidity that Joanna and Ingrid offered to the market was observed by the immediacy of the market order by Frank. Okay, so we have also to have in mind what we learned from the previous session, that market orders observe liquidity, whereas limit orders offer liquidity. Okay. And then we have market makers, which are always creating market around the current price, and this would explain the higher number of liquidity very close to the current price. Okay, people buy market makers. Market makers in a more generic term, not only broker dealers as we may think about, but also proprietary trading firms, for example, who exploit arbitrage situations. For example, they are also creating market, putting a bid in one market, an ask in another market, and thereby offering liquidity to the overall marketplace. Okay, so market makers usually have their orders very close to current price because that's their business is creating market. Okay, so this would be an idealized model, and the pending interest, you see, it decreases the more far away is the price from the current price. Okay, so we see a little bit more pending orders here at 1.7 because it's a round number. Being a round number, there are more. There's the tendency to accumulate more pending orders, but usually the normal distribution or the frequent distribution would look like this.